All right, good evening, everybody. Elliot Katz here for the Rich Options Jerk. Hopefully, you guys had a chance to take a look at my weekend notes. I said a little concerned here about the fact that the Dow's making new highs, a very narrow index, 30 stocks. Other things are lagging. Small stocks, IJR, which is the small cap ETF, MDY mid cap ETF, Russell 2000, all lagging. NASDAQ, both the comp and the 100 unable to make new highs. Why the Dow's making new highs? Little concern there. Why is the rally narrowing like this? Is it just because it's earnings season? Maybe it's the seasonality of the summer. We're going into historically what are some of the weakest months of the year. Hard to tell. As always, we'll let the charts tell us. Also the transport's still having a very hard time. So you got to wonder what's going on over there. Anyway, I made a point of that if the money's going out of those areas, where's it going? So we're going to have to watch for that. Well, today, fortunately for us, fortunately for the market, not for us, we really don't care. We can play it any way we want. But fortunately for the bulls, we had a nice move in the NASDAQ 100 today. We actually had a very nice rally of 35 points. And that actually bested the Dow today. Here's a look at our major in broad market ETFs, and if we look at the largest changes today, you'll see that it was the emerging markets that continue to lead, but under that we have the Qs and the NDX. So these emerging markets just don't quit. Haven't seen an opportunity of any kind of pullback to actually pull the trigger on these. But after that, you've got all the NASDAQs, and then after that, you have a couple of Russell items, and then you get to the S&P, and here's the Dow down here, up $28. The diamond's only up 13 100ths of a percentage point, while the NASDAQ 100 was up 6/10 of 1%. 59 100ths of 1%. Okay, well, fortunately, like I said, we saw a nice move. So maybe things are back in gear. Maybe we'll see this now coming back towards those highs. That would really be a good sign for the market that these stocks are able to reassert themselves. This week, from an earnings standpoint, I think we're going to probably be paying most attention to Disney and Priceline tomorrow. We've got NVIDIA on Thursday. We'll be looking at some of the retailers. We've got Kors and Ralph Lauren on Tuesday, and Macy's, Nordstrom, and Kohl's on Thursday. We'll see. Hopefully, maybe we'll get some recovery there. In the actual sectors, as I said, we had a nice rally finally in the technology sector. Our top industry ETFs were both semiconductor ETFs, the XSD and the SOX. There's the SOX index for you. And we also had a nice run in healthcare equipment specifically, and the metals. The metals had a nice day today, even though they closed off the highs. So probably led by Freeport here, up 2%. Let's take a look at that chart. Yep, starting to get back to those highs. Gonna have to look for something over there. Okay. As far as the sectors that lost it today, all energy. Okay, it looks like maybe my call on the energy stocks was a little premature. Earnings have not been coming out favorably, and a lot of stocks in the oil services patch have been getting pounded. We've got a Schlumberger bull call diagonal, which I will review with you. We also have a new trade today, so I'll go over those with you also. Okay, So that's pretty much the lay of the land on the market. Really don't have a lot to say on that score. So let's take a look at some of the trades, because in my notes I actually made a note of the trades that we've in the portfolio, that educational portfolio that we actually closed out. And the one that we closed out was the Veil. It was a September bull call spread, and my notes from yesterday said that the stock did reach our target price of around $10, and felt that with August 4th being Friday, holding on to this for another month and a half was not the prudent thing to do. So decided to sell it at 157 and take a 49-cent profit on a $1.08 initial cost on that trade. Now, why do I say that, right? You might be saying, oh my God, you're selling it at $1.52. You're leaving 48 cents off the table. Well, we know that once you get to the high strike on a bull call spread, your theta now is definitively positive. So just waiting around should be a good thing, right? Well, what's the flip side of that? The flip side of that is that with over a month to go before expiration, we're giving the stock a whole month to move around, which means it could go to 11, it could go to 9. Right now it's 10. So as a trader, the thing that you got to do is you got to balance those things out. Okay? Don't think that because you've got a spread that expires on a specific day that you got to milk it for every dollar of profit. You also have to weigh into the mix the fact that if the stock were to make an attractive move towards the price target that you have, then you got to really think about how much risk you might be putting yourself at by holding on to the trade. So let's take a look at Vail, and I'll show you what I'm talking about. Okay, so here comes Vail. Okay, and there's Friday right there. That's where we took the trade off. Actually, we missed an opportunity there, but you know what? It actually worked to our advantage because the spread actually widened a little bit because of the positive theta. And then today we had this pop. But remember, as the stock moves up, that positive theta is also matched up with negative gamma. So even though the net delta of the trade is going up, it might still be going up. It might be going up at a decreasing rate, and eventually it starts going down. So as you get closer and closer to expiration, as the stock moves higher and higher and higher, the net delta of the trade actually starts going down, starts heading towards zero as both deltas approach 1. So we could go out and we could price the spread at today's closing price of 10.35, but not going to worry about it, right? You got to kind of say, okay, had a nice profit. It was a really good trade. We read the charts well, and let's move on to the next trade. In fact, nothing's going to stop us from going back into this stock if we get a pullback and we see that it's starting to reassert itself. So Vail took that profit. And what else did we do? Something else we did, JP Morgan, right in here. JP Morgan started out with a 357 debit, long the September 90 calls, and short the July 28 93 calls. Those expired worthless, and waited until the Monday after expiration to sell the 93 calls for 21 cents, got our cost down to 336. Now the stock ran. I'll show you the chart. And on Friday, we actually decided to roll not to this week's 93, but to next week's 93 but to this week's 93 and a half. And what did that do for us? Well, it only gave us a nickel extra credit, but we did get our cost down to 331 because of the 336 minus a nickel, but now we're short the 93 and a half. So now the spread just changed from $3 to $3.50. If we simulate that, okay, actually not simulate it. Let's actually look at the account. Okay, right there, you could see that right now that trade is currently at 380. Let's call it 380. It's 382, but let's call it 380. Well, and the stock is 94. Okay, so actually the option we sold has come down a little bit. The option we're long is still up 62 cents. Don't focus on this P&L because this is the P&L of these two trades, of these two prices. It's not the P&L of the trades since the beginning. So at 380 minus 336, 331, we're up almost 50 cents there. So on this 5 lot, it's actually a $250 profit as opposed to a $315 profit because you're not taking into account the close of the other call, which we closed out at a loss, even though the roll actually gave us a slight net credit. And that's one of the things that you want to think about when you do these diagonals. Okay, we're going to be rolling. We're going to be moving things around. You want to keep track of your net cost because what you're going to see on your screen, regardless of platform, is only the P&L of the position that's up on the board. So you're not going to see the net effect of everything that you've done in the trade. So we're at 336, whereas this trade is at about 320. So there's a 11 cent difference from 331 to 320. There's a 9 cent difference. Okay, that's the 45 cents right there. So on the JP Morgan, if we look at the stock, you can see that, hang on, JP Morgan. If you look at the stock, you could see that the financials were really starting to reassert themselves last Friday after the economic news. Today was a little more of a struggle. I think Bank of America might have actually been down today. Let's actually look at the XLF. There it is. Let's look at what's in the XLF and you'll see yeah, the XLF was actually down a little bit. So it's the strong ones that are going to continue to see money flows. So you got JP Morgan, Bank of America was basically flat, was only down a penny. So Citigroup was up. Goldman up $3. Morgan was up a little bit. USB was up a little bit. So not too bad. Not too bad. Berkshire, I guess, was the drag because I think there was earnings today. But it did close off the lows, which is good. So we're going to be if we look at that JP Morgan trade in a little more detail. So there's our JP Morgan trade. You can see that we're right at 94.02. There you go. So at 94.02, you could see that this trade, you look at the bottom left, you could see that on Friday, the trade that is shown which was a 320 cost for a 5 lot, shows a $450 profit. So we're looking at a 91-cent profit on a $3.20 purchase, which brings us to 411. Our cost is 331. So on Friday, if the stock stays right here where it is, we're looking at an 80-cent profit on the trade, which we only put on a couple of weeks ago. So that would not be too bad. One of the interesting things about diagonal spreads is, as you can see, now that we're on the higher side of the strike, actually the stock going down is actually better for us. So it's actually what we're actually hoping over the next couple of days is that the stock actually backs off and heads back down to 93.5. It won't be so terrible if the stock stays at 94. The profit potential is nice, and the option we sold will only be 50 cents, and we can do another roll. But for the purposes, if we want to take it off for the maximum profit on Friday, we need the stock to be at 93.5. And like I said, because on Friday we saw the strength in the whole group pick up, we decided that it would be a good idea to roll that to the 93.5 right there. So we're right in there right now with that JP Morgan trade. Okay, so we did Vail and we did JP Morgan. Okay, let's see what else we got. eBay. Okay, eBay in the notes, I said I was getting a little concerned. We paid 84 cents for the trade. The stock was above 36 when we did the trade, and actually, technically, the stock was looking pretty darn good. Unfortunately, the stock here, let me give you a look-see over here. Look at the middle chart here. So we put this trade on July 26th, which is right over here on the bounce off of this support area. We did it for 84 cents. The stock actually broke that support level, but as the days went by, it stabilized, and my note was that if the stock doesn't start moving back up above 36, we really got to think about taking the loss, because we do have negative theta now with the stock trading below the long strike. Now we do have positive gamma, and fortunately for eBay, the stock did rally today to 36.11. It was high as 36.15 today, and the actual trade picked up 11 cents today. It's a 5 lot, so we got 12 cents today. So now we're all the way back to 72 cents, which is great because we only spent 84. So if the stock could stay in this area, move up a little bit higher, maybe we get out break even. I still think we're going to take this off for a loss. I'm not really that optimistic about this thing getting up to 38 at this point, but it is possible. I mean, if we could get it up to 37, we should be able to get out for close to a break even, right? Actually, it should be close to $1, right? Because if you have a $2 spread, 36.38 in the middle, the spread should be worth about half its value. So that's about $1. So we actually I could see us possibly making a little profit if the stock gets to 37. And that sometimes is something that you got to do. You know, it can't be right all the time. We've been very fortunate, except for that Google silly double diagonal that was more of an educational exercise than like a one-off, because we don't talk about it in the course, but I thought it was interesting to see. We're actually doing pretty well in these educational trades, because even though we can't personally recommend them, I want everyone in the class to be able to follow these and listen to me as I describe our decision-making process and how we're bringing the concepts from the course into each one of these trades. Okay, I have been looking for credit spreads. I really have. But as I mentioned last week, volatility across the board is kind of low, and you're not really getting paid. And because stock all of a sudden can move, it's kind of a dangerous game. So the diagonal is a way to collect some premium, even though these premiums are on the lower side, week after week after week, while the stock moves around. So if there's any one reason why the diagonals are more prominent at this point, it really is because of the state of premiums. So eBay, we're pretty happy today's action. It was a little iffy there at the beginning. Stock didn't look like I was going to make any headway, but all of a sudden, really took off, and you can see it's come off the support here on the shorter term chart. That's a 2-hour chart. So that's where we're at on eBay. Next, we've got Schlumberger, which is not my favorite trade on the board right now. When we put the trade on, the stock was 68. Today, unfortunately, it was down in the 66 range. Like I said, a lot of these oil stocks have been really getting hit post earnings. We've got the November 67.5, so I'm not too bent out of shape over it. Nobody likes to lose money. Okay, but right now the value of the position is about 215. Here we are at 215. And if you notice over here, we've actually done our first roll, which got our cost down to 266. So we're really only down 50 cents. And we've got until November. Now, it's a little early to do the roll because it was only Monday. But you could see that because of the action in the stock today, down almost $1, that this option's already worth only 6 cents. And we did, that's today on the 7th. And you can see we did the roll on the 4th. Now, what do you do in a case like this? Okay. Let me show you. Let's put up the Schlumberger, and I'll show you what you do here. There you go. Okay, so we're over here short these August 68.5s. Whoops. Got to add that strike. There we go. So there you go. This thing's worth 6 cents. The stock's 66.55. So if you wanted to, you could roll down for the same week down to 67.5 and pick up another 13 cents or 14 cents, which wouldn't be too bad. However, you'd be down to 67.5, and if the stock started moving back up again, you might be chasing your tail a little bit. On the other hand, you could roll out to next week's 68 now, or 68.5, and collect the same 13 cents and give yourself some upside if the stock starts recovering. Obviously, the thing about that is that you're getting 13 cents. Now you got to wait 2 weeks for it, right? You're getting 13 cents more for the week. So in 2 weeks, you can collect 13 cents more. But for the rest of the week, you'll actually collect 6. So that doesn't seem to be a very good deal, right? Because you'd be pushing your time frame out to 2 weeks, and you'll only be picking up an extra 7 cents. Right? You could drop down to the 68 and make it 23 cents. So this is a situation where you might want to wait to see if the stock can recover tomorrow, because this 68.5 call is not going to move very much. It only has a 9 delta. So even if the stock goes up $2, this delta is only going to get to 30. So if the stock goes up $2, this won't even be 40 cents yet. Okay, because the first delta will be 20 and then it'll be 30. So on the first dollar up, it'll be up about 9 cents, and then the second delta will be about 20 cents. So that's 30 cents. That should be about 35 cents. So this is one of those situations. These are the situations that I really don't like, but we'll wiggle our way out of it somehow, because we've got these November calls right in here that are trading at about 220. So, I mean, if you wanted to, the interesting thing is now that our cost is down to 266, you could actually roll this thing all the way to the November 70 for $1.20 and have a $2.50 spread for a net $1.46, $1.50. So you could actually just move this out all the way to the bull call spread. Just say, look, I'm going to risk $1.40 or $1.50 on this trade. And if the stock can get back to 67.5 or higher in November, then I'll make about $1. Okay, probably a little too premature for that, but you kind of get the idea of the kind of games you could start playing. But since we are option sellers, we generally don't want to put ourselves in a position where the option we're short is too far away, because we won't get any opportunities to manage that in terms of premium collection. So if we're not going to get a really attractive benefit from putting our sale 100 days away from the current day, if we're not going to get something that we feel is really attractive and beneficial, it doesn't make sense to do that. I mean, in the next 18 days, if we're looking at the 70, let's see, over here, this has about an 18 volatility. This one has about a 19 volatility. So in 18 days, which is 1/6 of that, I could pick up 40 cents at the 68.5 level. All right, so you could do that and multiply that by 6, and you could see the potential to collect more premium by taking smaller chunks out of it. That's because of the theta decay. Okay, so we're not happy about this puppy, but we will figure it out, as we always do. That's Schlumberger. Okay, what else? What else we got here? All right, well, we did the MasterCard trade last week. Let me show you why we did that one. This is one where I intentionally moved out to September 15th because I did want to have something that kind of looked like a bull call spread, but I didn't want to extend the short expiration out to October. Because what does this do for us, folks? It gives us one or more extra chances at collecting premium if we hold on to this trade to September expiration and the stock is below 135. So let me show you what this trade looks like, and when I show you the chart, it'll make perfect sense. So let's go over here. There's our MasterCard trade. Let's look at the risk profile right there. All right. So what do you see? Here is today, the pink line, and the blue line is the expiration date. But what do you also notice? You notice that over here, at about 132-ish, the profit that you get on today is about the same as you get on the expiration day. Now, I have always found that quite fascinating because to look at that place where they cross, because that to me would mean that if the stock got to 132 on any day between now and the September expiration day, I should be able to make close to $100 per spread. Well, the spread only cost us $275. So when I looked at this, I actually created this after I looked at the chart. So if you go to the chart, we'll use this one. We'll use TC2000. If you go to the chart, and you go to this high right here, there you go. You're at about 132. So with Visa making new highs, I said, hey, why couldn't MasterCard make some new highs? The stock's above the moving averages. Things look okay. You know, MACD's a little low here. But the group is pretty strong. So why can't it get back up to 132? Well, how do I create a nice hedge trade that makes me money if the stock gets up to 132? Could do it this week, could do it next week, could do it 2 weeks from now. Really doesn't matter, right? So that's how I came upon this trade with 132 as the price target, 132 right in the crosshairs right there. That made perfect sense to me. Okay, now if the stock starts running up and it blasts through the highs, then we'll be up here somewhere. You know, that's not a bad thing. Believe me, I'm not going to give the money back. If the stock pulls back a little bit here and September expiration comes along, then we'll figure out what we're going to do in terms of managing that short call. Now, if the stock backs off first and this September call actually collapses down to like 20 cents, we might decide to take that profit and then start using it more as a traditional weekly diagonal, right? And just keep collecting that premium. Okay. So right now, this trade that cost us $275, it is trading at $3.20. So we're actually making almost $50 per spread on a 275 initial investment, which is like we're getting close to 20% already. And we put this trade on on August 1st. So we're pretty happy with that one too. Like I said, this is a little different from a traditional diagonal because we don't have a short-term expiration here, but it was attractive enough when I looked at the risk profile up in here. I said, hey, that's pretty neat. With the short call in my pocket in case the stock goes down quickly, or in September we decide we want to keep the trade on and now use it as a regular diagonal, or maybe just convert it into a bull call spread because the 135 call for October will have value also. Okay, so there's your MasterCard trade. Today, new trade, Ambarella. We bought the September 22nd 51 call, and we sold this week's 52 call for 50 cents, which is actually a nice premium. So that cost us $2.60. Let me show you what the trade looks like. Should be familiar at this point. There you go. And I think we put it on when the stock was 80, what? No, not 80. 51.20 something or other. 51.20 now. I think the stock's 51.28. Let's see, where is it? Yep, 51.28. So this is only for this Friday. So if we want, this thing cost us $2.60. If we want to take it off on Friday, we'll make $50. And obviously, if we want, we can roll that for the next few weeks. Okay, so we got September 22nd versus August 11th. That'll give us more than a month. And the reason I did that one is because we got a new buy signal, new weekly buy signal in the guidance chart. There you go, Ambarella weekly buy signal. There you go. So we're actually looking pretty good on that. Now, why did I pick 52? Again, because the previous high was not that far above 52. Right? So what do we got there? 52.70, 52.40. Here's 52.02 from last week at around 3:30. So I think the stock, even if it's starting to move up based on that buy signal, I think this 52, 52 and a half area is going to be a resistance level. So if the stock carries up to 52 and a half, I'll actually be able to buy this back for 50 cents, and this 51 call should be riding high, right? So let's move this to 52 and a half just to make sure. And there you go, right there. See, at 52 and a half, we're still looking at a $44 expected profit on 260, which is over 15% for a week. Okay, obviously, we'd like to try to make more, but this gives you a sense of what we're doing here in terms of trying to hit singles and doubles much more consistently. So, like I said, except for the Google trade and the current eBay, we didn't take it off yet, so we don't know if the eBay or the Schlumberger are going to be losers. We actually have a nice batting average here so far. Really hitting for singles and doubles. And as I said before, going back into these stocks is at some point in the future is not a big deal. So what's on the radar here? I'm looking at a Vago, AVGO. I still call it a Vago. It's actually Broadcom. Looking at Celgene and Biogen, VMware, Pepsi. I think we got a nice chart in Pepsi. It's just the volatility's kind of low, so I'm not sure how we're going to play this one, but you can see it's starting to reassert itself here. Stochastics, MACD, DMI, short moving averages, moving up towards that higher end of the Bollinger Band. Right, looks like it's making a nice little reverse head and shoulders while it consolidates. This could be a nice mover. I'm hoping Disney gives some good earnings. But Pepsi, I'll show you Biogen. See, we're reasserting here after a pullback. That's looking good right there. It's past earnings, thank goodness. And the other one is Celgene. There you go. Also past earnings, pullback, restarting the move. So we continue to look for opportunity, trying to find a couple of trades a week if we can. Still really keeping our fingers crossed that this upward movement in the NASDAQ 100 really is a keeper here because they still have a little ways to go. And of course, we'd love to see the smaller stocks, move up. But if we're gonna, maybe something's going on with interest rates, maybe the lower dollar is favoring the bigger companies. There's a lot going on, a lot of cross currents out there. So yeah, that's pretty much it for today. We got a 40-minute session in today. Send your questions in to me, Elliot at investingshortcuts.com. And if there's no questions, you want to type anything in? Nope, nothing. You could always email me. With that, I'll wish everyone a fine rest of the evening and a good Tuesday, Wednesday trading, and I'll see you on Wednesday. Take care, everybody.